In this video, I am going to explain accounts of partnership firm. Before we see the problem, let me explain the basic concept of partnership. First, let us see the definition. Say, according to Section 4 of the Indian Partnership Act 1932, partnership is defined as the relationship between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. See, partnership means the general concept about partnership is two or more persons may become joint owners and each bringing in certain amount of capital and sharing the profit in agreed portion. Such relationship is called partnership. See here, we need to know certain things. In partnership agreement, the agreement is very important because all the terms and agreements will be recorded or mentioned in the partnership deed. See, the partnership deed is very important term. See, the document or the instrument containing the agreement between partners is known as partnership deed. So, partnership deed means all the informations, all the agreement and all the terms and conditions will be recorded in the partnership deed. See, here we have some general rule which is applicable to partnership firm in the absence of the partnership deed. Okay, if such information is not mentioned in the partnership deed means you can apply or you can follow the general rule. Let us see each and everything separately. The first one is profit sharing ratio. Generally, the profit sharing ratio will be given or mentioned in the partnership deed. If such information is not given in the partnership deed means the partners shall share the profits of the firm equally irrespective of their capital contribution. Then you can share the profit or loss in equal ratio. Okay, so you can follow this rule in the absence of partnership deed. And the next one is interest on loan. See, in any partner apart from his share capital advances money to the firm as loan, he is entitled to interest on such amount at the rate of 6% per annum. Third one is interest on capital. See, generally no interest is allowed on capital of the partner. If as per partnership deed interest is allowed, it will be paid only when there is profit. If loss, no interest will be paid. If such information is not given in the partnership means there will be no necessity to give any interest on capital. Then fourth one is salary to partners. See, generally no partner is entitled to get salary from the firm unless the partnership firm deed provides for it. If such information given in the partnership deed means then the partner will get the salary from the firm. But generally speaking, no partner is entitled to get salary from the partnership firm. This is a general rule. And the last one is interest on drawings. See, generally no interest will be charged on drawings made by any of the partner. This is a general or common rule if this information is not given in the partnership firm, or else if the information is given in the partnership deed means according to the percentage you can apply in the partnership firm. So if any such information mentioned in the partnership deed, then you can charge interest on capital, salary to partner and interest on drawings according to the partnership deed. But these are the general rule which is applicable to all partnership firm in the absence of partnership deed. In the accounts of partnership, first I am going to explain how to prepare capital accounts of partners. Say, in partnership firm, the transactions relating to partners are recorded in their respective capital accounts. So normally each partner's capital account is prepared separately. So generally there are two methods of capital account by which the capital accounts of partners can be maintained. There are two things known. The first one is fluctuating capital method and the second one is fixed capital method. Under fluctuating capital method, only one account, that is the capital account for each partner, is maintained. It shows or it records all adjustments relating to drawings, interest on capital, interest on drawings, salary to partner and share of profit or loss in the capital account itself. So as a result, the balance in the capital accounts keep on fluctuating. Okay, in the absence of any such information or any such instructions, the capital accounts of partners should be prepared under fluctuating capital method. Okay, the second one is fixed capital method. See, under fixed capital method, Two accounts are maintained for each partner. The first one is capital account and the second one is current account. The capital account will continue to show the same balance from year to year unless some amount of capital is introduced or withdrawn. The second one is current account. See, in current account, the transactions relating to drawings, interest on capital, interest on drawings, salaries, share of profit or loss, etc. are recorded. Hence, the balance in the current account change every year. Let us see the format of fluctuating capital method. I told you no, in fluctuating capital method, only one account is maintained, that is partner's capital account. This one is debit side and this one is credit side. So capital account is a liability, no. So liabilities always shows credit balance. Opening balance always entered in credit side. So buy balance brought down. These are the three partners will have a separate column for each and every partner. So buy balance brought down, opening capital balance, and then so any amount which is belong to partners that will be credited in partners capital account. For example, interest on capital which is contributed by each partner separately. The partner will entitled to get interest on capital according to partnership deed, if any. Interest on capital will be credited here. The next one is any commission given to partner that will be credited in partner's capital account. Share of profit. Okay, so any profit of the firm that will be belong to partners according to the profit sharing ratio that will be credited to partner's capital account separately. And if any partner entitled to get salary from the partnership firm, that will also credited in partner's capital account separately. Okay, now come for the debit side. So drawings. First one is drawings. Drawings means amount withdrawn by the partner from the partnership firm. So it will reduce the partner's capital account, because if the partner withdraw money from the capital, it will lead to decrease his capital. So debited capital account. Two drawings enter in the partner's capital account separately, debit side. Then any interest on drawing that will also debited in partner's capital account. And finally you will be getting balancing figure here. That is a total, credit side total and minus debit side total. You will be getting balancing figure here. Again this will be credited by balance brought down. So current year closing will be opening balance for next year. The second one is fixed capital method. So under this method, two accounts are maintained for each partner separately. The first one is capital account. In capital account, we need to have a separate column for each and every partner. And next one is current account. So in current account also we need to have a separate column for each and every partner. Okay, let us see the first one. See, according to fixed capital method, capital amount, that is the capital account amount will be remain same year to year. There will be no changes in the capital account. So every year it will show the same amount only, unless if any partner introduce any additional capital or if any partner withdraw any money from the capital account. In such case only here you will be getting some differences. For all other cases you will be having same amount every year. There will be no changes in the capital account. So the same amount will be shown every year. In fixed capital account, the second one is current account. See, in current account, all the transactions relating to interest on capital, salary, commission, share of profit, all these things will be credited in current account of partner, and any drawings or interest on drawings, these things will be debited in current account. So every year the current account will be fluctuating. So according to the transaction you will be getting different amount every year, but the capital account remains same. Every year you will get the same amount of capital account. This method is called fixed capital method. Let us see the problem. Show how the following items will appear in the capital accounts of the partners. John and Jalil, when their capitals are fluctuating and fixed. Here we have some information. They ask you to prepare capital accounts when the capitals are fluctuating and when the capitals are fixed. We have to solve this problem according to two methods. First one is fluctuating and the next one is fixed method. See the transactions. John and Jalil. Capital, that is opening capital as on 1st April 2014, 1,70,000. Drawings during the year. John 15,000, Jalil 12,000. Interest on drawings for John 600, Jalil 400. Share of profit for 2014 and 15, 10,000, Jalil 8,000. Interest on capital for John 6,000, Jalil 4,200. And partner's salary, John 5,000, for Jalil nil. Commission for John nil, for Jalil 4,000. So with this information, they ask you to prepare capital account of John and Jalil when their capital accounts are fluctuating and when their capital accounts are fixed. See, the first one is when capital accounts are fluctuating. Okay, debit side, credit side, capital account. In debit side, we have two columns, one for John and one for Jalil. In credit side also, we have two columns separately, one for John and one for Jalil. So first you have to start with opening balance. That is opening capital on 1st April 2014 for John 1 lakh, for Jalil 70,000. 1 for 2014 by balance brought down. That is opening balance, opening capital. How much? For John 1 lakh, for Jalil 70,000. Next one is drawings during the year. For John 15,000, Jalil 12,000. So this will be recorded under debit side of capital account according to fluctuating capital method. So year end 2015 March 31st. Two drawings, that is amount withdrawn from the firm during the year. Total amount is for John 15,000, Jalil 12,000. Next item, interest on drawings. John 600, Jalil 400. This will also recorded under debit side of capital account. To interest on drawings. 600, 400. See, interest on drawing also we have recorded 31st March, that is end of the year. So except opening balance, all other transactions we have to write March 31st, that is end of the year. Next one, share of profit for 2014-15. John 10,000, Jalil 8,000. This will also recorded under credit side of capital account. 2015 March 31st by share of profit. John 10,000, Jalil 8,000. Next one, interest on capital. John 6,000, Jalil 4,200. This will also recorded under credit side of capital account. By interest on capital. 6,000, John 6,000, Jalil 4,200. Next transaction, partner's salary. For John 5,000, for Jalil nil. So this will also belong to partner's capital account. No, this will be credited to partner's capital account. Same date, by salary. John 5,000, Jalil nil. The last one is commission. That is, this is the amount which is belong to Jalil. This will be credited to partner's capital account. By commission. How much? 4,000. See, here we have started with the opening capital and we have recorded all the transactions in the partner's capital account. So according to fluctuating capital method, all the transactions will be recorded in capital account itself. Now we need to find the balancing figure. Jalil total amount is 86,200. For John 1,21,000. Okay, enter the same amount here also. For John, 1,21,000. For Jalil, 86,200. Now you will be getting balancing figure debit side. That is, here we have 1,21,000. No, 1,21,000 minus 15,600. What is the balancing figure? 1,05,400. For Jalil, 86,200 is there. No. What is the debit balance? 12,400. 86,200 minus 12,400. Balance 73,800. On same day, to balance carry down. This will be transferred to next year. That is 2015 April 1st. By balance brought down. How much? 1,05,400 for John. For Jalil, 73,800. According to fluctuating capital method, all the transactions including capital account is recorded in one single account. That is capital account. See, the second one is when capital accounts are fixed. So according to this method, we'll have two accounts separately. One is partner's capital account and second one is partner's current account. Say in partner's capital account, you have to record the opening capital and the same amount will be recorded as closing capital. So there will be no changes here unless if there is any partner introduced additional capital, and when any partner withdraw amount permanently as drawing, in such case only here will have changes. For all other cases, you need not record anything in capital account. Here we'll have opening capital, closing capital, same amount. All other adjustments will be made in current account. See the same problem for fixed method. Say opening capital, John 1 lakh, Jalil 70,000. So enter this amount in capital account and all other transactions will be recorded in current account. 1st April 2014, by balance brought down 1 lakh and 70,000. Okay, the same amount will be recorded as closing balance. 31st March 2015, to balance carry down that's all. Get the total. 1,70,000. Here also 1,70,000. And all other transactions will be recorded in current account. See, drawings, this will be recorded debit side of current account on March 31st, that is 2015 March 31st. To drawings 15,000, 12,000. Then interest on drawing also debited in current account. Same date, to interest on drawing 600, 400. Share of profit credited to current account. 2015 March 31st. By share of profit 10,000, 8,000. Interest on capital also credited. By interest on capital 6,000, 4,200. Then partner's salary, John 5,000. By salary 5,000. Next one, commission for Jalil 4,000. Same date, by commission 4,000. Now find the balancing figure. So according to this method, you will be getting fluctuating balance. So every year the current account balance will be keep on changing. Here we have 16,200, but debit side only 12,400. Balancing figure 3,800. Total 16,200. For John, 21,000. Enter 21,000 here. What is the total? 15,600. What is the balancing figure? 5,400. So on 31st March, to balance carried on. For John 5,400, for Jalil 3,800. So this will be opening balance for next year. That is 2015 April 1st. By balance brought down 5,400, 3,800. See, in accounts of partnership firm, we have discussed capital accounts of partner. So, in capital accounts, we have discussed about two methods, fluctuating capital method and fixed capital method. Hope you all understand this concept. Thank you.